Good evening, everyone. We're presenting Hilton today. We believe the company is an industry leader with a high-quality business, but the market has priced in too much optimism. Our sell recommendation is based on a 3-year target price of $90, representing a 26% downside. Hilton is one of the largest hotel companies in the world, with over 1 million rooms and 112 million loyalty members. It enjoys 15% global RevPAR premium, driven by network effect. RevPAR stands for revenue per available room. It is a performance measure used in the hotel industry. It's calculated by total room revenue divided by total room nights available. It also equals to average daily rate multiplied by occupancy rate. Looking at the geography breakdown, currently 83% of the revenue is generated within the US. Hilton has been focusing on expanding overseas. Over half of its pipeline properties are outside of the US. In terms of segments, it's important to note that only 10% of revenue comes from operating income of properties owned by Hilton itself, and the remaining comes from fees paid by third-party owners. Moving on to industry overview, hotel is a cyclical industry with a low concentration and high competition. The global market size is around 1.2 trillion US dollars. Hilton ranks number 2 in terms of sales revenue and number of guest rooms. As you can see from the business model chart, Hilton plays in all 3 roles, but its prominent position is franchisor, where it generates income by collecting franchise fees and reimbursements from third-party owned hotel operating under Hilton brands.
Hilton has a good business model, and I will discuss this in 4 aspects. First, Hilton has a unique SLI business model. Over 95% of Hilton's rooms are either managed or franchised. This fee-based model offers Hilton high returns on invested capital and an operating margin of 17.5%. Hilton's managed and franchise contracts are typically 20 years, which offers a switching cost advantage. Second, COVID triggered an unprecedented industry shock. Hilton management took decisive actions to minimize cash burn, cut non-essential expenses, laid off and furloughed of nearly 22% of its workforce, and cut salary for executives. Since Hilton initiated the stock repurchase program in 2017, the company has repurchased about 4.3 billion of its common stock. Third, Hilton's loyalty members represent 60% of total occupancy. This strong loyalty program drives repeat business and achieves strong network effects. Fourth, Hilton provides a consistent and reliable experience at divergent price points. It builds a strong portfolio of brands that aligns with growing demand for limited service options and travelers seeking modern experiences.
Okay, so although we appreciate Hilton as a high-quality business, we do think that currently too much optimism has been priced in. The stock price of Hilton has been rallying, mainly driven by multiple expansions since the crash at the beginning of the pandemic breakout. Underlying is the market's strong confidence of a fast and strong recovery. Based on the implied forward multiples and our reverse DCF, we believe that currently the price has factored in a full recovery by year 2023, a strong mid-single-digit net unit growth for the next 10 years, as well as strong upside from the development of mid-market brands. However, we believe that the market overlooked several secular industry challenges and a bad risk reward. Firstly, for the overall travel demand, there will be a long road to recovery, especially for the business travel segments. Secondly, the substitution challenges from new lodging format like Airbnb has been strengthened during pandemic. Thirdly, if we look at the supply side, the pipeline growth could be struggled to regain pre-crisis momentum as the franchisees are facing severe challenges. Lastly, although management emphasized on the growth potential in mid-market brands, we do not think Hilton is best positioned to capture this upside due to the fierce local competition. Okay, so let's have a further look at our views on the total travel demand. We believe both the speed and extent of the recovery can be worse than expected, especially for the business travel segments. For the speed, it can take more than 5 years to return to the pre-crisis level. Historically, business travel has been more volatile and slower to recover than the leisure travel after recessions and disruptions. During the last recession, the international business travel from the United States didn't fully rebound for 5 years. And given that this time COVID has caused a much more severe destruction on the lodging sector than previous crises, an even longer rebound should be expected. And then in terms of the extent, we believe that some non-essential travel could be permanently reduced. Based on our study on the recovery pattern in China, the business travel returning phases with some sectors, especially the service and knowledge related sectors, disrupted for the long term. Companies in these sectors said that some non-essential travel budget are cut for good and moved online. And on top of this, we think the business travel in US or Europe may recover even less than in China due to the industry mix with higher level of those long-term disrupted service and knowledge-related sectors.
Now I will discuss the second risk. Hilton faces substitution from short-term rental in the leisure travel segment. First, let's look at the competition during the COVID-19 crisis. Since the outbreak, short-term rentals have maintained higher occupancy levels in 27 destinations worldwide. Several factors helped short-term rentals. They had more availability of inventory in remote markets as travelers seek to escape from urban regions where cases are rising. Average length of stay for short-term rental increased by 58% during the crisis, and they offer essentials including well-stocked kitchen supplies and workspace. As a result, RevPAR for short-term rentals have recovered to pre-crisis level. Airbnb rates are reporting higher than 2019 in many countries, while hotels still experience a 60% drop from previous level, as you can see on the bottom left. Second, let's turn to competition post-crisis. As people are used to Zoom conferences, non-essential business travel will take years to recover to pre-crisis level. Business travel composes a much higher percentage for hotel than for short-term rental sector. New travel demand for longer-term vacation rental might continue post-crisis as companies allow more employees to work remotely, which creates opportunities for competitors like Airbnb.
Let's take a closer look at unit growth. We believe it could be slower than expected due to the pandemic-driven downturn. For existing properties, third-party owners experience financing difficulties may close hotels permanently. To begin with, significant decline in revenue makes it difficult for owners to service their mortgage payments. 25% of hotel CMBS loans were in special servicing as of January. In addition, solvency is a bigger problem. Although some owners may have liquidity from other sources, they may also file bankruptcy if they believe the value of the property falls below the outstanding balance of the mortgage. According to CBRE, value impairment for hotel sector has been around 20%. Many CMBS hotel loans that defaulted have seen value decline for 30% or more. This is especially severe for properties in overbuilt markets like New York City. For example, owner of Hilton Times Square closed the property permanently and signed a foreclosure agreement with the lender. The property is worth less than 25% of its 2010 valuation. Switching gears to new developments. Although Hilton has a very large pipeline, some of the properties may not enter into Hilton system as planned or at all. Completion rates of hotel rooms went down significantly across the world. Deferred rooms increased by 72% compared to last year. Given the market trends and investment sentiments, those deferred rooms could be canceled entirely.
So management sees the bulk of future growth come from mid-scale brands in emerging markets, especially China. While we acknowledge the huge market potential, we do have concern over Hilton's ability to capture the growth, and upside can be less promising than expected. Competition has already become intensified in the emerging markets. In China, the market share of mid-scale brands by top 3 hotel chains has increased from 52% in 2016 to 77% in 2019. Developing mid-scale brands have become the top priority for these local chains. Over 50% of their pipeline is dedicated to mid-market brands. While Hilton has a local operating partner in China for its mid-scale brand Hampton, the partnership seems losing traction to the other 2 leading players, especially Huazhu. From consumers' perspective, Huazhu offers a much better loyalty program. By the end of 2020, Huazhu has over 150 million members, while Hilton has a total of fewer than 50 million in China. Also, Huazhu offers better value for money proposition and a larger store network with better hotel locations, which are the top two considerations for mid-market travelers. From the franchisee perspective, Huazhu offers higher IRR as it helps its franchisee to realize industry-wide lowest OPEX through its self-developed IT system. Last but not least, Hilton's local partner is also focusing more of its resources on its internal brands rather than licensed Hilton brands. All in all, due to the changes in travel demand, supply dynamics, and competition from both incumbents and new formats, we see a prolonged recovery path compared with the market consensus. We believe the key metrics of Hilton hotels, including ADR, occupancy rate, and RevPAR, will not recover until 2025, a 2-year difference compared with the market. And by applying a historical average multiple, a WACC of 7.5%, and a growth rate of 3%, will derive a 3-year target price of 19.5, or a 25% downside from its current price. Finally, we also conducted a scenario analysis, which reviews a bad risk award for Hilton. Under the bull case, we expect the demand to fully recover by 2023 and a favorable market environment for chain hotels in both near and long term. We also factor in continuous margin improvement over the next 5 years. However, we only see an 8.2% upside in this optimistic situation. On the other hand, under our rare case, if the path to recovery is further prolonged, or even worse, if certain demand is permanently vanished and supply is reduced, we see a downside as severe as negative 51%. Thus, we would like to reiterate the message we delivered at the very beginning of our presentation. Hilton is a high-quality business. However, currently too much optimism is priced in, which makes it a less attractive target. Thank you. And we now welcome any questions.